Hello and welcome to another episode of the Truth About Real Estate Investing show. This is Erwin Cito. This show is for Canadians. And did you notice how retail stores are already playing Christmas carols? I was bothered by this until Christmas truly came early in the form of proposed legislation from the Doug Ford government to allow triplexes on residential lots. This is the toughest talk I've ever seen from any government in Canada at any level, where we are going to increase housing supply to the missing middle that goes against municipal governments who are voted in by NIMBY constituents. I thought it was hilarious how the minister even mentioned how the NIMBYs have gone too far, so far as to become bananas. Banana is an acronym for the term was introduced to me by one of our 17 listeners, Christian Spielvogel, and that stands for build absolutely nothing anywhere near anything. Acronym for banana. I get it. No one wants more cars parked on front of their homes or on streets or condo towers that cast a shadow on their homes, nor do they want the values of their homes to increase by less. But unless more supply is created, there will be less homes for workers, people who pay taxes and contribute to our economy. Greater goods stuffs. Anyways, I can't wait to get into the details and share more at the Wealth Hacker Conference on November 12th on what the most optimal real estate investment property is going to be in a rising interest rate environment, inflationary environment, with an LTV, a landlord-tenant tribunal that's 8 months in backlog, including how to apply the latest technologies to maximize rents and minimize expenses. Wealthhacker.ca for tickets and information. My discount code for you is the 5-letter word TRUTH. Truth. If triplex by right wasn't good enough, the Bank of Canada looks like they've pivoted. Some people think it's bad that interest rates went up 0.5%. Understand that the market expectation, I believe 60% of those analysts were polled, were expecting 0.75. Governor Tiff Macklin's talk has been mostly very tough talk in terms of fighting inflation. But this most recent talk that he gave is the most balanced it's ever been. As he mentioned, the economy is softening and that economic data points, and also from the economic data points that I follow, like there was a flash Amazon Prime Day sale. And also, again, anecdotally, restaurants are noticeably less busy. Manufacturing inventories are down all over the world, and they're going to continue to go down as businesses are ordering less. They don't want their cash tied up in inventory during a global recession. At the same time, my friends who've been traveling mainly for pleasure, or my friend that works on Air Canada, they tell me how busy tourism is. For example, Italy is still busy. Understand that the busy season for travel usually ends when the summer ends, but travel was still busy throughout September into October, and airlines are already continuing to add more flights, even though oil prices are high. So there is room for inflation to continue to come down in the travel sector, but in a lot of the other sectors, it's brought the economy down. Why is 0.5% good news for investors? I anticipate future increases will be fewer, less frequent, and we may even go flat pretty soon. Then we'll see only a slow rise till rates are cut again to save the economy. So I'm guessing 1, maybe 2 more interest rate increases. I would guess less than 0.5. Again, I'm guessing. There's too many things going on in the world that can happen, and so these things change almost on a daily basis. But this past week has been some major economic announcements. And again, at the Wealth Hacker Conference on November 12th for a one day all day event, I'll be sharing more how to take advantage of this information for an optimal real estate investment portfolio. Also, we have the best vendors on hand. All the folks that I do business with or recommend all in one place under one roof, all for one day only. We have folks coming in. We have vendors coming in from all over the country. We have a bunch of services with the latest technologies. For example, Front Lobby. The owners of Front Lobby are based in BC, so Vancouver. So they're coming to Toronto for this. They own Landlord Credit Bureau, which most people may know, be more familiar with. Landlord Credit Bureau. I use it in my own portfolio. I've imposed it on my property managers to use it for my clients as well, to hold tenants accountable to their credit. Rent Panda, a high-tech screening and leasing services. they'll be in the house as well. Single Key, who just bought Neighborly, which was big news. We have folks coming in from Alberta from Single Key for this event. For Single Key is for those do-it-yourself landlords to help landlords screen tenants, and we'll have some actually pretty good offers coming up thanks to Single Key. They also offer rental insurance, which is something I think some people would like, especially used with deeper pockets out there. We have my personal insurance guy, Jason Lowe from Ascendant Financial. More and more people, a lot of people have done really well the last few years. I know right now is really tough, but in general, overall, if you've been at this for over 5 years, you've done really well. So I see more and more people getting interested in whole life insurance because honestly, it's what the rich people do. Suite Edition's Andy Tran, for all you home edition geeks, design geeks. Andy will be in the house. Like, he's my go-to guy when I have questions around zoning. Ken Beaconham's Legal Second Suites, my good friend. He's also into addition design, renovation, and construction. You definitely want to meet him. Dalia Barsoum, of course, one of our platinum sponsors of Streetwise Mortgages, who is probably the most in-demand mortgage professional in our community. You want to hear what she has to say on the investor journey, because no investor journey happens without inexpensive money. And if you haven't been paying attention, it's those who have expensive money who are the people who are hurting really, really badly right now, including bankruptcies that I'm getting into arguments with people over social media. We have multifamily expert Seth Ferguson in the house. He's the guy that can teach you how to do apartment buildings by yourself, or if you want passive registered options for your folks who are licensed under Ontario Securities Commission, like the highest, strictest level of securities screening. We have Ecotron Inc. for real estate developments and real estate investment trusts, short form REITs. So if you want either growth in your investment portfolio or if you want income, Ecotron has options for you. We have exempt market dealer Stephen Blazik in the house representing Pinnacle Wealth. Pinnacle Wealth place my money, my registered funds, and my mom's registered investments, which are doing just fine in this market. That's just one of the few things that are green in my portfolio. Shout out to Pulse Investments. Entrepreneurs Organization, Toronto chapter is also in the house. This is a private membership group for 7-figure entrepreneurs that Cherry and I belong to. If you are a business owner, I can't recommend this enough. You'll be able to speak to Yannick while who's representing EO Toronto at the conference November 12th. Calvert Mortgages, the lender of choice for private fast funds for your burrs or your flips. They'll be there for the 12th as well. They're coming up on the podcast as well. So not only can you borrow money from them, they have investment opportunities in the business itself should you be interested. They are registered as well. They're an exempt market dealer. So not a recommendation. Talk to them if you want more information. All the connections any professional investor needs will be there under one roof, so you don't need to go anywhere else. And that's on top of our expert speakers that I've talked about enough on this show. Speaking of expert speakers, today we have Dalia Barsoum, who's everywhere these days, and who can blame her? She's incredibly popular because she's really smart, and you'll hear it as well when we go through this interview. She's diligent in her underwriting. She coaches her clients. She guides her clients towards quality, which I think more people could use that going into this market. Unfortunately, Dalia and Streetwise are picking up the pieces from deals gone sideways, brokered by other mortgage brokers or people who just got themselves into too much debt, too expensive debt. I know the feeling of having to pick up pieces. It's incredibly rewarding work, but I feel so sorry for the people that got hurt. So today we chat about where rates are going, what private mortgages, rates and terms are going sideways, what investment deals are going sideways that the both of us are having to pick up the pieces on. From other, we had nothing to do with the origination. They're just coming to us after the fact to help them get out of this mess. Some tips on how to weather this rising interest rate environment, including joint venturing, who our favorite economists are to follow, where the challenges are in getting new financing, apartment building financing update, and much, much more. Cheap debt is what makes the world go round, which benefits real estate investors. So you don't want to miss this episode. Dalia knows how to get that cheap money. She knows how to maximize it, and most importantly, keep you safe. Have a pen and paper ready. I give you Dalia Barsoum. Hi Dalia, what's keeping you busy these days?
Hi Erwin. What's keeping me busy these days? Really the new environment we're in, and the questions from clients, the solutions, the navigation of the new qualification rules. All of that is what's occupying my energy, where my energy is going.
So let's dig into it. What's like the top question?
The top questions are about cash flow pressures I'm finding and the impact of the rate increase on budgets, especially for clients who are on an adjustable rate mortgage or a variable rate mortgage where the bank has adjusted their payment because they've hit something called the trigger rate. So the questions are, Dalia, the rates have gone up on multiple properties. That has eaten into my cash flow, or on my primary residence has increased the payment. How can I alleviate the pressure? That is the common question. That's the first question we're hearing right now. What do I do? And I'm happy to talk about some of the solutions we're proposing. And then the second question is, I want to continue to buy properties because the market ahead will present opportunities, but I'm hearing that qualification is tougher. How am I being impacted right now because of these higher qualifications? Because now we're qualifying at a 7.5% versus 5 point something. So these are the top two, I would say. And of course, the third one is the rates. The R word.
Okay.
Do I lock into a fixed? Do I take a variable? Where are the rates going? Top three.
We could be here all day just on any one of those topics.
Yeah.
Okay. Let's start with where do you think rates are going? I have my murky crystal ball. I'd love to hear your thoughts.
Tell me about your murky crystal ball, and then we can talk about it.
My murky crystal ball is based on not much. I Googled some things, and therefore I'm not an expert. For example, I Googled what inflation was last year. It was, September CPI for Canada was 4.4%. So where was our controlling our 2% target then? Like 12 months ago, we were above target. Where was the cut, right? So that leads me to think the Bank of Canada might be slow to respond to any sort of headwinds we have going forward. And so I'm not holding my breath for when they cut. I'm going to guess 2-3 more raises, and in general, they're just going to follow the U.S. Fed. And the U.S. Fed looks like, from what they're saying, looks like they really want to put an end to this runaway inflation.
Yes.
And
Yes.
I can see why, because, for example, I've been mentioning this a lot. CRA, the union, so the employees of CRA, want a 33% raise in their new contract negotiation over 3 years. And the teachers, Ontario teachers, can't blame them. They rejected their contract offer, which had a very low raise in it, right? So if we are to control government spending,
Yes.
inflation has to come down.
Yes. Yes.
Right? So,
Yeah.
so I'm not holding my breath. I think we're in for a few more rate increases, which is funny because I thought, 2 more rate increases. 2 more rate increases. That was 2 rate increases ago. So the quality of my crystal ball is not very good.
Yeah, my rate oracle retired. She retired. She just retired.
Or did you fire her?
I used to lean on her. I'm being politically correct, yes. I just read a statistic that Canada is the top G10 country in terms of the pace they've increased interest rates are at. So they're actually up there in terms of the pace of increases and the magnitude of the increases. But I'm with you. There is still room to go with the overnight rate increase. I mean, we started to see an improvement in core inflation, but I think it's too early to say, hey, we're starting to see results or sustainable results. Again, I lean a lot on industry experts and research, and I do a lot of reading, and I don't have that crystal ball, but what I am gathering is there is more room to increase the rates this year, likely at the upcoming Bank of Canada meeting in October, and there's another one in December. Is it going to be by the same magnitude that we've seen? Unlikely, but there is probably another 0.75 baked into the system is what I am gathering. And then the banks if history repeats itself, the bank tends to sit on that rate for a period of 18 months or so before they start to remove their feet of the brakes. And fast forward 18 months out, sometime in 2024, we may see an improvement to the overnight rate as the Bank of Canada tries to re-stimulate the economy. On the fixed rate front, there is an expectation based on the 4-year swap that the fixed rates will improve sometime next year. When? I don't know. So when clients ask me right now, do I take a variable or do I take a fixed rate? If I am to make a new rate decision today, what should I do? Here's what I'm telling clients. If you're on a variable and you're okay with another, 75 to 1% increase and you can absorb it, stay with a variable, because fast forward 18 months out, there is a good chance the rates will start to come down and you will benefit. If you can't sleep at night, you may want to consider what's called, the first option is adjustable rate mortgage. The payment changes as the rate changes. If you can't sleep at night, then let's look at a variable rate mortgage where your payment stays fixed, but as the rates rise, more goes towards interest versus principal. So you can sleep at night because your payment is flat, but beneath the surface, the allocation changes. And when the rates start to go down, more of that payment will go back to principal. So that's one option. Second option is 1 or 2 years fixed. Interestingly enough, the advantages of variable rate have diminished above fixed rates, because right now variable rates are at or even above the 5-year fixed, where in the past there was a big, advantage. So 1 or 2 year fixed. Why?
Sorry, then the banks are basically saying the fixed will come down during those 5 years.
Yes.
Because why else would they be low? Why would it be at or lower?
Exactly.
Than the variable.
Exactly. So if you lock into a 5-year fixed right now, in my view, we're locking in at the height of the cycle. So fast forward, when the rates start to come down, that mortgage payment will be locked for the duration of the term, and then the market is going below that. So to sleep at night, 1 or 2 years fixed right now, if you're to make a rate decision, or a variable rate with a fixed payment, or if you can continue to absorb the increase and want to pay down the mortgage, then stay with an adjustable rate mortgage.
And then folks also with the several properties, they don't have to do all one strategy for the whole portfolio.
Yeah, absolutely. You're right. Yeah, it depends on the property, depends on what they're looking to do with the property.
Yeah.
How much cushion is in it.
Yeah, for example, I was speaking to one of my clients, it made sense for him to keep the variable on his single family properties versus his duplexes and student rentals that he plans on keeping for forever. He chose to lock them in because as investors, you should look at which ones would you sell off, or do you want to sell off? The ones with the least value add options.
Yes.
Hence the single family homes that cannot be converted into a different use, a higher, better use.
Yes.
Now, I want to make this clear to the listener, not all lending institutions can do all these strategies.
Right. Depends on how you qualify and what lender we're talking about. And one key thing to consider if you're trying to make a rate decision right now is to also consider whether or not the property has equity in it. Because if I know that values have gone down, but nobody's equity is down to zero unless they,
just bought recently.
Recently. But if there is equity where you can lock in or add in a secured line of credit on the property, and especially an advanceable line that increases as you pay down the mortgage, do that before you choose to lock into a fixed rate. Because if you lock into a fixed rate and later you want to invest because the market ahead is going to present opportunities, you want to make sure you're going to be able to access that equity and not pay a penalty. And we know the banks change the rules all the time, so there is no guarantee that you would qualify with that same lender to set up a line of credit. So set up the line before you lock into a fixed rate.
So just so everyone knows, no one gets their questions in advance because I think of questions as we go. You mentioned
you're throwing them at me.
Apologies. No one's listening anyways.
Right.
Something I want beginners to avoid. For example, you mentioned opportunities are coming. I saw opportunities come across my desk. These properties were distressed sellers who already started renovating. So the pictures on Realtor.ca showed no kitchen because they'd already removed it, no bathroom, no toilet because they'd already removed it. They're mid-renovation. They're distressed sellers.
Yes.
Now, how does one finance something like that? Because I would hate for a novice to try to get into that thinking that their pre-approval with a Schedule A bank will get them financing on that.
Great point. Pre-approval, I just want to comment on it quickly. Pre-approval means that you've been given a range of mortgage amount that you can theoretically get approved for. But pre-approval comes with a bunch of conditions.
Yes.
Right? There is all of that fine print. And one of the fine prints...
How much fine print? Pages? In small font?
Very small font. What's the smallest font we can talk about?
Oh my.
Yeah. So what's the fine print? We want to see income confirmation. We want to make sure that credit is still there for the lender that you've been pre-approved with. We want to make sure that the down payment sources are approved. And this is something we actually deal with a lot in pre-planning. We don't leave it to the last minute. But since we're talking about conditions, property condition is big. That's 50% of the approval. 50%.
Okay, so pretty important.
Yes. So to your question, Erwin, if you have a rundown property, let's say you are pre-approved for a $500,000 mortgage and you need $500,000 mortgage on that property. Well, given that it has no kitchen, washroom, and has got it, that's private money. That is not a traditional loan. So you get private money. We make sure that we understand what you're going to do with the property, how much renovations you're putting in, when are you going to finish it, what do you expect the value to be, the rents to be, and before we take on this private money, we want to make sure you're able to refinance and pay it back. So that's basically the way to go about it.
Right. Sounds like there's a lot of planning involved.
Yes.
Could you imagine someone try to pull this deal off at a Schedule A bank with a branch person? No offense to the branch people. I just know that my experience is when you're at the branch, you're really defined with what they have to offer.
Yes.
Right. And I've been quoted a private at a Schedule A bank, and it was very expensive.
Oh, really?
Oh, the lender fee was over 3%.
Really? Wow, that's expensive private money.
Oh yeah.
Yeah, that is expensive.
And the rate was high too. It's like higher than anything that you and I would see on a regular basis. But at least you and I have quite a bit of exposure to the private market. The novice doesn't.
Yes.
So the novice might
take it.
Well, the banks aren't rich for a reason. Are rich for a reason. They're very good at taking money from us.
Yes, I used to work for a bank myself for 15 years. So, I was an insider at the bank, knowing why things get recommended and what options are typically offered. So, yeah, I can relate.
Right. Now we talked about so many things. This is terrible. I'm merging together two questions. Is private financing part of the financial roadmap?
Yes. So do you want to talk about the financing roadmap?
Yes, let's talk about it.
Okay. So
who's it for?
So the financing roadmap is really for investors who are looking to scale up a portfolio. So typically someone has a primary residence and they're looking to grow. Often investors have a primary residence. They bought their first property or their second property, and now they see the power of investing in real estate, and they're looking to grow that portfolio to 30, 40, 50 properties, and then at some point get into apartment buildings or smaller construction projects. So what the financing roadmap is it's our exclusive methodology around how we plan financing to scale a portfolio, and how do we actually get money at the best cost of money. Because as an investor, you've got multiple money tools available to you. You've got private money, you've got joint ventures, you've got bank money, alternative money, commercial money, and sometimes there are options to use RSPs, as you and I know. So the question is, and equity, of course, right? Equity. So the question is, if you want to grow, what does that look like from a money standpoint? And this is what the financing roadmap outlines for every client. So we talk about where are you currently? What are your goals? Are you looking to get into flips, or is it buy, renovate, refinance, or is it student rentals, or is it multifamily? What is your strategy? And by how many properties are you looking to acquire by when? And then we look at where's the money going to come from, okay? And what type of money do you use first to actually start building up that portfolio? And not only that, how are we going to make sure that we maximize on your borrowing power? Because sometimes if deals are not structured the right way or the wrong money tools are used, it does impact the numbers. It's a numbers game.
Yeah.
So we talk about where's the money going to come from, what to use first to get to the first round of properties, how are we going to maximize borrowing power to keep the approvals coming,
and from which lender,
and from which lenders, yes. So we pre-plan that, and then how are we going to structure your deals? Who's going to be on title? Is it a personal? Is it a corporation? We talk to your accountant, because there are always pros and cons from a financing standpoint, and then we answer any questions. We open up your eyes on the mistakes or things you need to be aware of. Simple things like, hey, I'm getting into the burst strategy, I'm running the numbers, and I'm going to be able to refinance at 80%, take this much money out at this rate. Well, let's wait. Let's validate that assumption. Let's make sure
stress test it.
Yeah, and stress test it, exactly. So these are some of the mistakes that we see and we share with everyone who's doing a financing roadmap. And then we basically put it into practice. So first round, you want to buy 4. Okay, here's how it's going to look like. And go shop. We're going to close the deal based on what we talked about. Once you've hit that milestone, let's get together again and plan the next round. So it is really a map around how financing is going to come together to support your goal. And it is customized for every client. It's an intensive document, and we do a 1 to 1.5 hour planning session with every client to put that together.
And this costs $10,000?
It is complimentary, believe it or not.
No.
Yes.
You know, fee-based financial planners charge for this.
I know. Actually, my financial planner said, this is gold and you should be charging for it, but we are not. We're not.
We probably shouldn't mention where people can find this.
Well,
our 17 listeners are voracious learners, so they may collapse your website.
It is on our website. You can book a complimentary planning session and request a financing roadmap, and that's how you kickstart the process. Okay,
so it's I'll leave it to you if you want to share where they can find it. Because
on our website,
our 17 listeners, there's a good chance all of them will do this.
Streetwisemortgages.com. Streetwisemortgages.com.
Okay.
Book a complimentary planning session. Okay. And to answer your question, private money, absolutely, it's part of, the money toolbox that we talk about. And we do private money as well, but I only use it as a stepping stone, or for some very, very sophisticated investors who are, comfortable with that type of money and they know exactly what they're doing. They rely on private money. So it depends where are you on the investment journey. And we want to make sure, obviously, you have an exit strategy.
Right. So it's a really good point, because I've always been afraid of private lending personally. But again, it's such a big topic, right? And I think the people that are hurt right now, investors are hurt, including like the developer that we were talking about early offline. Like they were having to pay debt. They had debt coverage. They had to pay interest costs. So for example, what was the year? It was probably like 2009-ish, when, if you remember, I won't say the name because I'm probably gonna get it wrong. A condo developer went bankrupt.
Yes.
Right.
Yes.
And before for about 20 years before that, the housing boom, like between basically 1989 and 2008, it was all boom.
Yes.
Right. And so for a developer to go bankrupt, who had built a huge condo, all these realtors were, I don't even know what happened to people's deposits, but all these realtors, they lost their commissions, or they had to pay it back, probably, whatever they did receive. And then just the lesson from that was they were a beginner developer. It was their first high-rise condo property they were building, and they had debt. They had to service debt. which is what I think what caused the bankruptcy. They eventually sold the property for more than they paid for it, which is wonderful. So some people got paid out. But then ever since then, I've personally stayed away from any sort of development that has to pay debt, right? That was long. I don't even know if I put in a question in there.
Development is the riskiest type of real estate strategy.
Yeah. And I can't believe people will accept that kind of risk for 12%.
You know, Aaron, here are things that typically dilute, I guess, the decision when people make a decision to invest. Things are packaged nicely. They're packaged in a fancy way.
Yeah.
People are dressed so well.
Yeah.
They talk well, and the project looks fantastic. And then there is a dinner, and there is an event.
Yeah.
I'm being blunt here,
Yeah.
okay? I'm not saying every project is like. I'm not saying this is about. I'm just saying that take the fanciness of the sales pitch out of decision making and focus on doing diligence. And assessing risk in anything you do. That's it. I said what I had to say, what I wanted to say.
It's actually, I won't say who because I don't have permission to use their name, but a friend of mine actually said, these projects are mezzanine financing essentially. And the professional investors will want 30% return versus what was being sold out there was 12% return. So why would I accept 12 when the smart money wants 30? So yeah, I don't know.
Yeah, and on your message about the returns, okay, I published an article on private lending called Beyond the Double-Digit Returns. Beyond the double-digit returns. It is not all about the returns. It's about, I come from a banking environment, so this term is used, maybe the audience is not familiar with it, but it's called the risk-adjusted return. So you gotta look at the risk for the return you're earning. You can't compare one investment that is earning 30% to another investment that is earning 12% and go, oh, I can earn 30% here. But what is the risk?
Yeah.
What risk are you taking? That is a question that I find is missing in some of the conversations.
Yeah, they're just not having the conversation. A lot of people didn't. So, sorry, trying to get this back on track. Where I was originally going with around private lending. Because for like the smaller investors right now, and I imagine you're seeing it.
Yes.
Is that a big challenge? People who have existing privates?
I'll share some stories with you. Real stories fresh out of the oven. So I've never been a big fan of very high leverage on anything, whether traditional money or private money, specifically private money. So I know creative strategies. I know that investors love to pick up deals with less money in the deal. I'm an investor myself, but I've never been a big fan of high leverage private money. So here is what we're seeing. There are investors who took very high leverage private money at the height of the cycle 6 months ago. That I'm talking about money on the street at 100% financing of a first mortgage with 100% financing for renovations on multiple.
God. So above loan to value.
Yes, above loan to value on multiple projects that are running in parallel at a time where we know, you and I know, trades have become more expensive. Things have been taking longer, supply chain, all of the stuff that we know about. So unfortunately, high leverage is a no-no in my view, but that's the situation we're seeing right now. We're seeing some investors, unfortunately.
That's a house of cards.
That's a house of cards. It is. We are seeing some investors who have approached us saying, hey, I was working on a buy, renovate, refinance. I expected the market to rise by the time I'm done. And now I am in a position where the value is below all of the debts that I have on multiple projects. And some of my private lenders want out because they don't like where the market is heading. It's a painful situation to be in. And
my Lord.
I haven't seen that before. This is the first time I see it.
Right. Well, the market secured us all.
Yeah. So there are solutions. They're not necessarily easy solutions, but there are solutions. So that's one thing. And the other thing about private money is validating exit before we enter the deal. By validating, I mean, it's not about saying, oh, I will refinance or I'll sell the property. Validating exit means let's actually underwrite the deal upfront as if you're going to that future lender down the road. So I want to gather income. I want to look at credit. I want to assume where the rates is going, where the values are going, and be conservative and run the numbers to see how much you would qualify for with which lender, how much you're going to be able to take out. It's not something we leave till the end to figure out.
Right. Let's do some planning if we can get this to a Schedule A bank.
What's that?
let's plan if worst case happens, because I always plan for worst case, like that I can get a lender and then I can rent it out. Worst case, rent it out and hold it.
Exactly. You got to have multiple, A and B and C plan. But I find with private money on the street, there is an abundance of private money. Actually, people are looking to put money into good deals, right? So the mistake that I often see is investors take private money. It's easy to get, and then they don't do the work up front to validate exit because they're going, like they have a rush deal, or they don't want to provide a lot of paperwork, and they deal with it later, and later is where the problems lie. The art is in exiting the deal, not in entering the deal.
Yeah. It sounds like Warren Buffett says, like, if you're going to buy a stock, you plan to hold it for like 10 years. If I'm private lending, I'm planning to, for the worst case, that we have to hold that property for 10 years. These people are asking for their money back. I'm guessing they didn't do that.
No. In some cases, unfortunately not. So we're seeing different challenges in this market. Are there solutions? There are. Some of them are not straightforward. And in some cases, there are no solutions, depending on how severe the case is.
Any fresh out of the oven examples of people being able to exit successfully, unsuccessfully?
Okay, so let's go back to that example of a client having a property upside down with debt. So now there is
which is very easy
Yes.
when you're 100% everything mortgage, everything lended.
Yeah.
Oh, do you share what like a range of rates? What the rates were?
The rates on 100% financing and high leverage private money, I've seen rates anywhere from 10 to 15% with 2 to 3% in fees. That's what I've seen. And then on renovation money, hear this, I've seen rates at 17 and 18%.
Oh my God.
With high fees. Again, these are not mortgages we arranged.
That's been clear.
Clients,
these aren't you.
Yeah,
you're picking up the pieces.
Yes.
Right.
Yeah. These are clients coming to us in a challenging
to pick
situation.
up the pieces, not because you set them up.
That's right. Yeah. So with someone who's got
apologies. Were there brokers involved in any of these? Just out of curiosity, or was this privately arranged?
No broker deals.
Oh crap! So there was. Oh boy. So So, just for clarification, mortgage professionals brokered these private mortgages?
Yeah, as far as I know, yes. Yeah.
Oh Lord. Okay.
As far as I know, they were brokered, yeah.
Like, oh man, you need a unicorn deal to make these numbers work.
Again, if you were using this type of money, and I always tell investors, like, here is the risk with this type of money. And some investors are comfortable with the risk, regardless of what I say. They want to take the risk, regardless of what I say. They think I'm too conservative and they want to take the risk. Fine, okay. When the cycle is going up, the high waves are lifting all boats. Yeah. Now the wave is gone, and this is where the issue is.
Yeah, we see who's swimming naked.
Yeah. So to answer your question, someone has a private mortgage and they took high leverage, and the value now is upside down. So if you want to do an 80% refinance, you can't. There is a shortage, right? So what are some of the solutions we're looking at? You don't look like you believe there is a solution, but there are a couple of options.
You can sell something.
Well, if you can sell and absorb a loss. Yes, you're right. But
or something from an existing portfolio, right?
Yeah, so that's exactly where I'm headed. So some investors who wanted to sell are not selling for the prices that they thought are going to sell for, or the properties are sitting on the market longer than desired, so their burn rate is very, very high.
They're paying 15 to 18% on the money.
Their burn rate is very, very high. There is an investor who came to us who's paying, do you want to hear the number?
Oh, yeah, sure.
I was gonna die. I was gonna have a heart attack, and I felt so bad. His monthly cost on 3 rentals, high leverage, with all of this type of money is $15,000 a month.
They're rich though, right? They can handle this?
No, they're not.
Oh,
they're
crap.
Not. Okay. So back to solutions. One solution is, like you said, to look at the rest of the portfolio. If the investor has a portfolio, if we have a shortage, can we extract equity from somewhere to pay off the private lender through a refinance and cover the shortage from the rest of the portfolio? That's the easy solution, right? If there is equity. Another option is to go to the private lender and say, hey, right now your money's secured against air, technically, right?
Yeah, your security's gone.
Yeah, you're secured maybe at 80% against equity, but the rest of the money is secured against air, against nothing.
Yeah.
If you even want to power of sale of this property, you're going to lose money. So how about...
Yeah, you take a paper loss immediately.
Yes. So how about we pay you through a refinance, and for that shortage, we secure it as a second mortgage against another property in the portfolio that has equity for, let's say, a year or 18 months or something until the market corrects, and then at that point we pay you that remaining portion. So that requires negotiation with that private lender, right? That's number 2.
Right.
Number 3 is to rely on a combination of equity and unsecured loans. There are lenders on the street who are providing unsecured loans up to $50,000. They are not cheap, and I use this as a last resort. But let's say there isn't enough equity in the portfolio to cover the shortage. Can we take some, and can we take an unsecured loan temporarily to clear it? It's better than getting the property into a power of sale, and it still helps from a cash flow standpoint to a certain extent. So that's solution 3. Solution 4 is to find a JV partner who can come to the deal, inject money into the deal.
In this market?
Well, it depends on what you're giving the JV, because here is the thing. I mean, you have a property. If you rent it, it can cash flow if you have a good rate mortgage on it. So if someone is willing to come on board and benefit, inject some money into the deal, we use some of that to clear off the private, and then we refinance the property with a JV partner with an A lender, then the numbers start to work again. So these are the 4 solutions right now.
Not easy.
No.
The saying in my head comes, the saying, an ounce of prevention is worth a pound of the cure. Mm-hmm. So if they just had a proper plan, they would have hopefully foresaw how bad this could be. Maybe done 1 property instead of 3.
Yeah, it's the house of cards, right? Because when you have high leverage money and private money, and the clock starts ticking and things go sideways on projects, it's much easier to deal with one versus to deal on multiple at the same time, right?
And also, you mentioned earlier, like really, really professional investors. Like the really, really professional investors I knew, that know who take on private money, they're paying like 8% or less for like 100% loan to value type stuff, right? They're not paying 10 to 15.
Yeah, I mean, there are sources of private money that are cheaper, especially sophisticated investors get to a point where they've established their own network of individuals who are comfortable lending them money because...
And usually it's a whale.
Yeah, there is a whale, a trust and the relationship, so they would give preferential pricing. And I mean, the pricing in the private market ranges depending on who you're dealing with and your experience and all of that.
And I mean a whale, like not that they're I won't say too much, but I mean, they are financially just beyond comfortable with their cash position.
Yes.
Right. Which is not likely with these folks these private lenders who want their money back.
Yes.
Probably a very different demographic. Okay. We've talked a lot about this.
Yeah, we've covered a lot.
So, I meant to ask you crazy things we've seen. I think we got that. Oh, home equity line of credit maintenance. Because it often comes up around these times. I remember it came up a lot in 2017. People's questions were around because a lot of investors use their home equity lines to finance their investing, down payment or renovations. So people often ask, will the bank ever take it away from me or reduce my capacity? What are your thoughts? Have you ever seen it?
I have not seen it, but
and you have lots of clients and
a lot of clients
who have lots of home equity lines.
Yes,
Okay.
A lot of clients who've utilized their home equity lines. But here's the thing. I mean, in mortgage agreements or line of credit agreements, the bank reserves the right to blah 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 blah. That's standard language, right, with the banks to manage the risk. So I've seen a situation where a bank pulled a line of credit because the client defaulted on their payments, which is expected, right? Like if someone is defaulting on their payments, the bank is going to shut down the line, the credit facility. If the credit score of the client has gone down significantly, the banks monitor credit scores behind the scenes. So maybe in some cases they may get uncomfortable, but that's like a soft decision in my view. It's not like a black or white rule. And then on line of credits in particular, I recommend that clients pay principal down, when they can. They don't just make interest payment forever, because the bank wants to see that you're paying down the debt. And if you're sitting on a line of credit at a high utilization and it's interest only for a very, very long time, that could raise some concerns about the ability to, repay that debt. So always make an effort to put some principal payment towards that line of credit. So these are my tips.
All right. I'll find some money to put into it. Because I've been around a long time. I only recall one person ever saying this happened to them.
It's very rare. I haven't seen it except for one client.
Right. This gentleman was in Alberta, and he said he just went to the branch manager and they got it fixed. And this was years ago, right? So again, I only know of one instance of someone I know personally. So I don't know what the risk is otherwise.
Yeah, there was a lot of talk about this during COVID because clients were concerned that, the banks are getting conservative given the COVID environment. Are they going to pull the lines? There was a lot of talk, and I haven't seen anything happen other than that one client. But again, it was a default situation. It wasn't anything else.
Oh, can I ask another question I didn't prepare you for? Do you have any favorite economists?
Favorite economist? I
follow
example, Benjamin Tal.
Okay. I saw his Bloomberg interview this week.
Yeah. I follow Benjamin. I find some economists, with all my respect to economists, some economists I find just paint a doom and gloom. The day of doom is coming picture, and I can't listen to them.
Yeah.
I can't.
I like to read them all. And then see what they all agree on, kind of like a diet, like a diet plan basically. I like to read them all and see what they all agree on. Like leafy green vegetables, they all seem to agree upon. So that stuff won't kill me apparently.
Yes.
Just need to be more disciplined about it. But yeah, again, I'll read the doomsayers to see what they're saying, and then I'll check on their track record. That's the other thing. A lot of people are like, oh yeah, this guy said doom gloom, but yeah, he's a economist at this company. Like, okay, what's his track record? Well, he's been a bear for the last 10 years. Well, what's his track record then? He hasn't been very right, has he?
Yeah, no, this is absolutely a great point. Yeah,
right.
Yeah.
But I like Dr. Sherry Cooper. I was just reading her.
Yeah, and Dr. Sherry Cooper for sure. Yeah. Yes, that's the second one. Yeah.
Right. And again, I'm asking because I worry about my own confirmation bias. Just because I like them, I'd like to hear contrarian opinions. So 17 listeners, if you have other economists you like, let me know.
I like in the mortgage industry, I mean, he's not an economist, but I like the depth of the research he does and the insights he shares. His name is Rob McLester. I actually interviewed him recently on our Adapt and Thrive series. Really, like it's about the research for me and the track record, like you said. So he's another analyst that I follow.
I'm just so worried about confirmation bias because it keeps getting repeated almost across everyone that we follow. I'm not gonna speak for you, say who you follow, same people I follow. But they all say we don't have enough houses. I think CMHC came out yesterday saying we're not even our housing starts are not even going to match their predictions. So the shortfall is greater than what they predict.
Oh, surprise!
So it's well, yeah, because you can't build anything in this market.
Yeah, it's not a surprise. Like, yeah.
For anyone who can hear the drilling in the background, we're getting new windows in, and the gentleman who's putting them in told me they had to wait 4 months for them. Right? How are you supposed to build anything? How are you supposed to schedule anything? How are you supposed to burr a property when it takes 4 months for windows?
Yeah.
Right? So.
Yeah. Talking about like waiting is I'm ordering, and I'm not building anything. I'm just ordering furniture for my house, and I ordered back in July, and it's coming in November. Couches, like, wow.
Lots of things have improved. It's good. And then the permit for the hole in my wall, I don't know how long it's been taking. It's just a permit. It's just paper.
Yeah.
For just a hole in the wall. Like, everything's slow. Anyways, we're off track. We were talking about whole life insurance because, again, another thing that I've heard consistently among people in our community, generally people who do pretty well. So I asked you before we start recording if you invest in it as well.
Yes. Or
do you even view it? Sorry, I'm putting words in your mouth. You own whole life insurance. I don't mean to say that you invest in it. I view it as an investment. So, but I love asking you about it because you have it.
Yes.
And you understand the mortgage implications of owning whole life insurance. Can you share on the subject?
Yeah. So my whole life insurance policy is under my corporation, and obviously I contribute to it. And
so you're using cheaper after-tax money to pay for it?
Yes.
Because it's through the corporation versus paying personally.
Yes.
Because you're rich, so you pay probably maximum personal tax, right?
It's well, I'm always looking for tax efficiencies and ways to optimize, right?
Yeah.
So this was this was one powerful strategy to have it in my corporation, so that I contribute through the corporate money, and then there is a cash component that accumulates that I can access if I want to buy properties or, for any reason from a real estate standpoint. Some lenders are opening up to now considering this cash value towards down payment, and they're not taking it as debt in the calculation, which is nice.
Yeah.
Because when you take money from your insurance policy, you're taking a loan from the policy, right? But some of the banks are not they're not looking at that as a loan. So it's a powerful tool in my view.
For example, I had a past guest who mentioned that if you have gold, the bank will look at it for a collateral if you have a good amount. How is whole life insurance seen as in terms of a quality of collateral for the lenders that do? It's just
looked at as net worth, part of your net worth. It's not collateral. They're not securing.
Sorry, I'm using the wrong words.
Yeah, they're not securing anything against it, but it is an asset on your balance sheet.
Got it. Yeah. So it improves your net worth situation.
Yes.
Maybe I'm using the gold analogy and the wrong analogy.
No,
that's why I have experts like you on.
You're bang on, Erwin. So it is part of your net worth, but you can leverage your insurance policy to extract cash to put towards rental properties if you want. And some of the banks are good with that.
Right. So I would categorize you as smart money. So it seems to make sense. It validates Cherry and I doing this, because I usually talk to insurance people about this. Like, oh yeah, you know the saying, whoever you're talking to, whatever they sell is always the solution.
Yes. Yeah.
Right?
Yeah.
So I wanted more context, which I appreciate. Thank you again from Smart Money. So if you're doing it, like maybe I'll do it too. Do more of it. Because for example, Cherry and I, one of our plans for next year is contribute more to our whole life insurance, because we don't want to have to sell any of our assets when we pass in order to pay the tax man, tax woman, tax person, tax people.
The tax people.
The tax people.
Everything, yes.
Yeah, because they need to fund their 33% raises, I understand.
Yes.
But yeah, I'd rather pay less tax. I'm sorry, my point is I'd rather have my insurance pay for our tax liability when we pass. So then things can continue operating.
Yeah, that's what I like about the life insurance policy, to cover your future tax exposure, right? Mm-hmm. But at the same time, you're able to access the cash value of it to do something if you want in the meantime. Right. So you're not just paying for coverage on the future. Right. You can access it today if needed, and that's where that is very powerful in my view. And
it's the difference between term insurance, which is what the vast majority of people have.
Yes.
Especially if they have an employee plan, a company plan, insurance via their company plan. It's almost always term. I've never heard of anyone on a company plan who has whole life, just because it's way cheaper. So.
Yes, term is cheaper, and for the life insurance policy, I know it's more expensive, but also it's a long-term commitment.
Mm-hmm, mm-hmm. Any benefits to having term insurance for mortgageability?
When it comes to mortgage insurance, I always recommend talking with a third-party company outside of the lending institution to get it, because if you leave that lender, you don't want to lose that policy. Whether it's term or not, it's not something that I can comment on, because I am not in the insurance business.
Understand. Me neither. But I've never taken mortgage insurance from the lender.
Good. They obviously, it's a product that they offer, but it doesn't work best when life changes, right? Things change. So you don't want to go and reapply for your insurance if you choose to switch your mortgage from one institution to another.
Right. Which happens.
Oh, life happens, and it will happen.
Right. I think I've turned over all my mortgages to different lenders.
Yeah, so you want to have independent provider of your insurance policy.
That makes sense. Seek expert advice. Not from the person making, we're running out of time, but I wanted to ask about apartment buildings, because we've seen massive correction in the single family space pretty much almost everywhere across Canada. The more expensive, the bigger the correction. The more investor popular that area, the bigger the correction. I was talking to friends in Windsor, for example.
Yeah.
It was in the news that Moncton, which was a big New Brunswick, was a big hotspot for many people leaving Ontario and BC, and they're expected to lead the decline for Canada. I'm just rambling. What are you seeing in the multifamily apartment building space?
We're seeing more and more investors move into multifamily. And I understand why, because in that asset class, especially if you're renovating, you have more control over the value add, because the valuations of apartment buildings is very different from single family homes or residential, where they're looking at comparables, and apartment buildings is based on the net operating income. So we're seeing more appetite to buy apartment buildings, and also because of the multiple units, despite the fact that also interest rates are higher in the multifamily space, because of the economies of scale, the numbers are looking more attractive from a cash flow standpoint in that space. So we're definitely seeing more and more investors go into 5 units and above. And we started servicing out of province investors actually this week in Alberta, British Columbia, Nova Scotia, Saskatchewan, and Edmonton. And we're seeing more and more apartment building deals in these markets.
So in the deals that you're seeing, have any of them corrected in price at all, like we see in the regular residential market?
I'm finding that the apartment building sellers are still holding ground when it comes to what they want to sell for, compared to the residential. So people are saying, I'm going to get better deals in apartment buildings right now. We're not seeing it yet. Right. We're seeing the sellers more open to offering vendor takebacks, but price-wise, we're not seeing a reduction per door yet.
They're smart.
Not yet.
That's because they're smart.
Yeah.
The sellers are smart. They know they probably got in correctly, and they're probably trying to exit how that makes sense. Yeah, because for the listeners' benefit, generally, if sellers are willing to take vendor take-back mortgages, they usually want a higher price on the sale.
Right. Exactly.
Yeah.
Exactly.
Yeah.
While on smaller properties, or when like the 1 to 4 units, we're seeing now deals with negotiations, clients going in offering asking or below asking, putting in conditions. So there is more leverage for the buyers right now in that space.
Would I be correct in my assumption then that the single family is where the greatest room for negotiation is?
Residential, 1 to 4 units.
Yeah. I'm guessing one unit would have the most negotiation versus the 4.
Yes.
Yeah.
Yeah.
It almost leads me to think like, yeah, that's tough though still. I don't know if I want to buy a single family because I'd have to renovate.
Yeah, I mean, unless there is an opportunity to do something to increase rental income and cash flow, right? I don't know. Single family is a question mark.
Are many condo investors coming across your desk?
We're seeing some investors that have purchased condos pre-construction. Depending on when they purchase them, they may have variations in value depending on when they were purchased, but not a lot. I mean, I'm not seeing any big challenges in that space. One of the challenges I'm seeing is someone who bought a house, wanted to sell their house, and their house is no longer selling, right?
Yes.
So they can't really bridge through traditional lenders because the lenders want to see that you've got a firm sale agreement to give you a bridge.
Right.
And they still need to close, and they firmed up conditions. So that's a situation we've seen some cases in. And
probably small, not a big number.
Not a big number.
Okay, interesting. Any assignment issues? Do those cross your desk? Like, for example, if someone can't close on their pre-construction condo deal, are you seeing investors picking up assignments?
So there are a few investors who approached us who had multiple condos that they were looking to assign, and they
How many is multiple? Like 5, 10?
4.
That's a big bite.
Yeah, that's a big bite. Yeah, and they're all going to close within like 2 to 3 months from each other. So they're coming up for closing. They're not closing yet, and they were planning on assigning them. One of them.
Oh boy, in this market.
When they bought them, like when they committed, their plan was to assign these deals, right? One of them is a house that is at close to $2 million that this investor wanted to assign.
Wow.
Yeah.
This is no condo. $2 million house. This must be gorgeous.
It is gorgeous. It is gorgeous. It's a beautiful lot. And yeah, in the market we used to be, this would have been a no-brainer. But now this investor has to figure out, okay, how am I going to keep these? What's my holding cost? How am I going to close them? What type of mortgages am I going to get? And that's the type of discussion we're having right now. So some investors who were in the assignment game may not be able to assign as they initially thought right now. They have to hold on to these properties for longer. And the question is, what does that look like?
Did they plan for that? Because again, for me, it's like if I was to buy pre-con, my plan F would be to close on it, rent it out, hang on to it.
Yes, I know you would plan that way. You would teach your students to plan that way.
This investor did not.
Unfortunately, there are some investors who did not go through that.
Were all 4 of these properties houses in the millions?
No, condos and this house.
Okay.
Yeah. Condos and this house, yeah.
But we're still talking like $4 million of exposure.
It is.
That they have that they get mortgages on.
It is a large exposure. Yes, it is a large exposure. And I find a whole discussion didn't take place initially. So.
My word. And this is the truth about real estate investing, folks. These are things that people do.
That's the truth.
Right. I'd argue, not the best planning, but we have planning available for folks apparently. Because would the financing roadmap have saved this individual?
The financing roadmap we would have discussed this part and avoiding the mistakes.
Plan F?
What's your plan?
Close and hang on for 10 years?
Yes, in case you cannot assign.
Yeah. Because housing corrections happen.
Yes.
And I know it's painful for everyone, but again, these are cycles. We've been on a bull run since like 2009 was like nothing.
Mm-hmm, mm-hmm.
But yeah, we've been on a bull run since then. 12 years, right? It can't last forever. Wow. Okay, Dalia, I could keep you here all day, but obviously Cherry needs you. Any final thoughts? I've hogged a lot of the question in airtime.
I enjoyed this conversation. All of the questions you asked were great. My final thoughts, Erwin, really is about the markets ahead, right? Definitely we're navigating new waters here, and anybody out there who's experiencing challenges or is concerned about things, it's about planning and understanding what the options are, and there are solutions. It's not a one size fits all. There may not be solutions. You may have thought there is no solution, but there are always ways. That's what I believe in. Mm-hmm. And what goes up comes down, and what comes down goes up. So on the rates front, I know at some point things will improve. It's not going to be anytime soon. I don't have the crystal ball, but like we talked earlier, likely sometime in 2024 we'll start to see some breathing room. It's 2 years away. So what are we doing in these 2 years to
deals.
hold, right?
I'll be looking for deals.
Yes. So there are clients who are experiencing pain, and we want to deal with the pain so that we can get them back into a state where they can thrive in the market ahead. And then there are investors who are in good shape, who want to get ready for what's ahead. So this is the time to plan. This is the time to actually dig and find solutions and pre-position if you want to invest. And that's really all I wanted to share as a wrapping point.
Right. And folks in distress can go to your website and reach out to one of your team members?
Absolutely. Yes. Streetwisemortgages.com, or they can email us at info@streetwisemortgages.com.
Fabulous. So no to 17%, 18% renovation?
Please don't take high leverage private money right now, folks. Please don't. Even if someone wants to offer it to you, please don't.
What if someone wants to lend? Still no?
If you ask me, I will always say no to high leverage private money, and my view will never change on that.
Jeez. I wish all the epic investors listened to this before this. Thank you so much for doing this.
You're welcome.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.